This is such a predicament of Cirrus research. The latest issue of the model behavior centers on this a close look at the earnings forecast for equities, specifically within the large, small markets, also at the sector level. And the title, after looking at the data, the title is "The Sell Side is Behind the Curve in Light of the Credit Markets." In this report, what we study is really the level of expectations by the sell side. So if we're looking at forecasts for the year out, this is time series data that measures that sort of sensitivity. In this case, it's the smaller cap market. The larger cap data is actually quite similar. And what this relates is that in really bullish times for the outlook, especially as we're coming out of the pandemic, the level of estimates that we had seen had climbed to about 60 to 70%, meaning that 6 or 7 out of every 10 estimates were getting raised. Where we're at today is really more of like a 4 out of 10 estimates, exactly a 37% reading. This is telling us that you're sort of like business as usual, and this range could actually go quite a bit lower. This becomes very relevant, especially if we consider the question mark around the banking system. As things stabilize, this potentially could be constructive. But for now, it seems to us that the hurdle rates are still too high. So as we go into this coming reporting season, we're likely to get some further guidance downwards. If you were to look at how markets behave going back 20, 30 years when you're in this sort of neutral bound, it's fairly benign. So the expected return is roughly a 3% expected rate of return the subsequent 6 months. However, if you look at where expectations really bottom, that number basically goes fourfold. And so for the contrarians that are waiting for bad times to really race into the equity markets, it seems to us that this current level is still too benign for a true higher or above returns marketplace. If we look at the specific segments, what this curve does is it looks at the top line growth versus the earnings expectations. And so this gap also troubles us. It would be very different if this top line growth had really tumbled and is starting to turn up. So we're in a different place. At the sector level, groups like industrials, technology are still at the upper end. While we're okay with industrials for the CapEx themes we've underscored, the reality is that technology spending is likely to continue to slow. One of the areas where the expectations are especially high within the tech sector is application software, where 7 out of every 10 estimates are currently being raised. So the idea here is as we continue to brace for a slowdown, as we continue to witness technology firms lay off people, the idea here of a 70% expected raised in estimates clearly remains way too optimistic. Also, just given the state of affairs, what do the banks look like? And this number shows that in the last 6-8 months, these numbers have plummeted. However, that number is still below that sort of pandemic low or Great Recession low. This number will be updated in the next few weeks just because the industry, the sector is so fluid. We suspect this will climb lower. And at some point, we probably hit a material bottom. With any questions, feel free to reach out to us. Thank you.